Hello students, in this video let us learn how to calculate net present value of two machines. So before calculating net present value, let us understand the cash flow required to calculate net present value and how net present value can be calculated. That is the formula required to calculate net present value. The cash flow required to calculate net present value, that is NPV, is income or profit before depreciation and after tax. So it can be calculated by deducting depreciation from the cash flow first, then deducting depreciation and add back the depreciation after deducting the tax. This is the process to determine the profit before depreciation and after tax. First we need to deduct depreciation, then we need to deduct tax, then we need to add back the depreciation which has been deducted in the previous process. So it is the process, it has to be followed in the same method. First we need to deduct depreciation, then we need to deduct tax, then we need to add back the depreciation to determine income or profit before depreciation and after tax. So the net present value can be calculated by deducting original investment from the present value of cash inflow. So original investment will be given in the problem. We need to calculate present value of cash inflow by multiplying discount factor with the income or profit before depreciation and after tax. Discount factor will be given in the problem. So if you multiply that discount factor with the profit before depreciation and after tax, you will get present value of cash inflow. So if you deduct original investment from the present value of cash inflow, you will get net present value. So if you get positive value of NPV, that project can be recommended or can be accepted. If you get negative balance, then that project has to be rejected. Now let us learn how to solve this problem. The Syntax Company Limited is planning to purchase a machine. Two alternative machines are selected for evaluation, each costing rupees 3 lakh. Each machine costing rupees 3 lakh. The cash inflow are expected to be as follows. They have given cash inflow for 5 years for machine X and machine Y. And the company's expected rate of return is 10%. This 10% is required for the discount factor, calculation of discount factor. The evaluate the profitability of two machines by taking the present value at 10%. The present value of rupee 1 is at 10% is 0.909, 0.826, 0.751, 0.683 and 0.621. So here they have not clearly stated us to calculate net present value, and they, indirectly they are stating that evaluate the profitability of two machines by taking present value. So since they are it has been stated to evaluate the machines, that is two machines, by taking present value at 10%, we should understand that by using net present value method we need to evaluate the projects. So in this problem, since they have not clearly stated the cash flows are whether before depreciation and before tax or after depreciation and after tax, and also since they have not clearly stated about the depreciation and tax information, we are not supposed to deduct depreciation and tax. In the sense, we are not supposed to follow the method of deducting depreciation and tax and add back the depreciation. We need to calculate net present value by using the same cash flow without any addition or deductions. So first let us calculate present value of the cash inflow by multiplying discount factor with the cash inflow. Here for machine X, first we need to write the years, then discount factor as given in the problem for 5 years. Then cash inflow that is given in the problem 20,000, 65,000, 90,000, 1,50,000 and 1,75,000. It has to be multiplied. 0.909 into 20,000 you will get 18,180. In the same way 0.826 into 65,000 you will get 53,690. Then for third year 0.751 into 90,000 you will get 67,590. For fourth year 0.683 into 1,50,000 you will get 1,02,450. For fifth year 0.621 into 1,75,000 you will get 1,08,675. So after finding out of the present value of cash inflow, you need to make a total of the present value of cash inflow. If you make a total, you will get 3,50,585. So from that you need to deduct the original investment, which is also known as initial outlay. Original investment given in the problem is 3 lakh rupees. So 3 lakh rupees has to be deducted. So if you deduct 3 lakh rupees from the present value of cash inflow, you will get 50,585 for machine X. In the same way we need to calculate for machine Y. Since year is written here, no need to repeat that. Write the discount factor. Since it is 10%, discount factor will also be the same. Then write the cash inflow for machine Y, which is given in the problem: 40,000, 1,10,000, 1,20,000, 1,40,000 and 2 lakh is given in the problem for machine Y. So now multiply discount factor with the cash inflow. If you will get 36,360 for first year and 90,860 for second year. If you multiply 1,10,000 with 0.826. In the same way for third year, multiply 1,20,000 into 0.751, you will get 90,120. For fourth year, 1,40,000 into 0.683, you will get 95,620. For fifth year, 2 lakh into 0.621, you will get 1,24,200. If you make a total of the cash present value of cash inflows, you will get 4,37,160. So from that, if you deduct original investment, which is given in the problem, that is 3 lakh rupees, you will get 1,37,160. So after calculating net present value, we need to compare the machines. So here the net present value of machine X is 50,585. In the net present value of machine Y is 1,37,160. Since net present value of machine Y is greater than net present value of machine X, machine Y is suggested to buy, because after deducting original investment, that is 3 lakh, machine Y is going to yield, in the sense after deducting original investment, the net present value left out with the company is 1,37,160. But in the case of machine X, only 50,585 rupees will left with the company as a net present value. So it is recommended to buy machine Y. Thank you, students.